Ravi Muthukrishnan, head institutional equity at Elara, to talk about his outlook for the equity markets. Good morning. And Ravi, when we chatted earlier, you seemed very enthused about the overall direction of the market. Elections, of course, are going to play a big role, and you believe that if everything goes as per what the market is expecting with respect to the BJP government gaining a majority and PM Modi as the front runner, then the rally is definitely going to remain intact. But what is the outlook from now up until that date?
Good morning, and thanks for inviting me on the show. My sense is the markets will continue to remain volatile with an upward bias till the elections are over. And as you rightly pointed out, if BJP were to come to power, I think it gets a new impetus because all the building blocks are there in place, and the markets will take off from there. And the economy also should take off from there. So ideally, our historical analysis of past elections tell us that it doesn't really matter which party comes to power, but in this case, because the building blocks are already there, I think the economy will be on a sound footing once the BJP comes to power. And post that, I think it's the earnings and the multiple which will take care of valuations. My sense is if BJP comes back to power, you can expect a re-rating in the multiple, especially because the political risk for the economy would drop, and the risk return for or let's put it this way, the cost of equity for India would tend to fall. As a result, the multiples can expand. So for me, we have a target of 12,000 for CY19, but it could even go up if the multiples re-rate.
Fair point. Also, what one is seeing, much unlike the previous time that the Nifty was at these elevated 11,400 levels is, Ravi, that the broader markets as well has begun to participate. Do you think this is a sustainable move? Will it last long? Or do you think this is just a dead cat bounce in an extremely oversold pool?
See, one good thing which is happening in the market, especially what happened in the month of March, is the FI flows have been pretty robust. I think in this month, in the last 10 days, we've had almost about 13,000 plus crores of money which has got into the economy. That's primarily because of the pause of Fed rates in the US and liberal stance by the other central banks, which has made more money to flow into India. And I think this flow will continue because once people see that the fundamentals are beginning to improve, I think more and more money can come in and this market can trend upwards. And that's sustainable for quite some time, at least.
Right. So let's take a look at what you're perhaps bullish on at a time like this, Ravi. What are some of the themes? And let's take them one by one. I noticed on your list you've also got the capital goods sector as one that you're, looking at. Preferably, just talk us through the strategy there, why this is looking good to you, and any select names as well on your radar.
Okay, when you look at cap goods, the first thing which made us quite excited is the fact that there has been a good sizable allocation for the railways, which means the transportation cap good companies should do well. T&D has been doing well for some time, and I think they will continue to do well. We also think that companies into airport modernization will do well. A lot of companies will have to fulfill environmental norms moving forward, so cap good companies meeting those environmental requirements should do well. More than that, even the infrastructure space has got a good impetus in terms of the budget allocation, so companies in that space also should do well. So if you were to look at the companies which we think will do well is somebody who is doing pretty good in the metro space, somebody is doing well in the T&D space. For example, KEI is a good company to look at. We like PNC Infra in the infrastructure space. We also like, as of now, I think anybody in something like metro should do well. So I think BAML should also be a good bet moving forward. That's about the cap goods.
Okay, let's talk autos and auto ancillaries. You believe that there is some steam over here. Are you betting on the two-wheelers or the four-wheelers, and what kind of auto ancillary companies do you believe could see a strong future growth?
For the OEMs, I think there's still a bit of pain left because there's a lot of unsold inventory. So if you were to look at short-term, OEMs are not the place to be in because a lot of negative news around these OEMs. But when you have to look at these companies with a slightly long-term perspective, maybe 1 or 2 years, I think Maruti still is a good bet because it still has been able to retain its market share despite all the competition coming in. They have new models to offer. There's been some cost savings which has been happening in the last couple of months. I think this inventory issue, which has been haunting Maruti for some time now, will soon be a thing of the past, maybe in the next couple of months, maybe 3 to 6 months. Likewise, in the two-wheeler space, we continue to like Hero MotoCorp because of the rural impetus they have. The scooter business is something they have to watch out for, but the motorcycle business is doing very well in the rural space. So that's about the OEMs, but when you come to the auto anchs, we would expect in a time like this when the OEMs are not doing well or where we think that the growth is going to be slightly dampening, it's sometimes worthwhile to play the auto anchs which are in the replacement space. For example, Excite Industries is one, MRF is another. We like both these stocks in the auto anch space.
Ravi, is there merit in looking beyond the obvious names when it comes to banks and financials, beyond corporate banks and beyond the top NBFCs? I mean, if I were to call out the list of the biggest contributors and the biggest movers within the Nifty Bank, it's Bajaj Finance, ICICI Bank, HDFC Bank and Axis. Would you say that perhaps, one can look beyond these four names?
See, in the large cap space, we still continue to like HDFC Bank because of the retail focus, and the same reason applies to even ICICI Bank. We don't cover Bajaj Finance, so I wouldn't be able to comment more on that. In the case of both these banks and including Axis, why we like them is that there is a strong rural retail growth which we are expecting, particularly in the housing space, which most of the business has now been taken over from the NBFCs. But in the smaller bank space, we like City Union Bank. And then, of course, if you're going back to the big ones like HDFC Bank and ICICI Bank, we also like them because their CASA is pretty strong. And in some cases, with these NCLT resolutions happening, their margin expansions could also happen. The asset qualities are also improving. So net-net, it's been a win-win in all these four fronts for all these banks. So we like them and we expect them to do well even after the elections, because once the capex cycle tends to revive, we would also expect the capital lenders, especially the ICICI Bank in this case, would also be getting a fresh impetus because of the capex plans.
All right, Ravi, appreciate you joining in and giving us a sense as to where exactly you believe investors should be deploying money. It's very stock specific. Banks with a retail focus, consumer staples, as well as select stocks from the IT universe and consumer discretionary. That's the take coming in.